All right, let's get right into it. We are looking at a really high stakes financial scenario where some, frankly, bizarre signals in the silver market are pointing towards a potential endgame. This is a story about paper promises versus physical metal, and believe me, the clock is ticking.
And that's not just hyperbole. The data we're about to walk through suggests that the way precious metals have been priced for decades, well, it might be about to change in a really fundamental way.
So, this whole thing kicks off with a really strange anomaly in the futures market. It's something that has even the most seasoned traders sitting up and paying very close attention. So, what is this signal that's got everybody so worked up? Well, to get it, you really have to look at how the big money is positioning their bets for the future. Okay, now look at this. What you're seeing here is just wild. At the start of November, traders were holding about 100,000 contracts for December delivery. Pretty normal. But by the end of the month, that number just collapsed all the way down to 9,000. So where'd everybody go? They all stampeded into one single contract. March 2026, that's more than 2 years from now. It absolutely exploded from 34,000 to over 112,000 contracts. And here's the thing you have to understand. This is not normal. This has never, ever happened this early, this fast, or this big. It's like a whole herd of elephants deciding to cram through one tiny doorway, all at the same time. The big traders, the ones who might actually want the physical silver, are avoiding the present like the plague and piling all their risk into one single month way out in the future. That's a massive red flag.
But why? Why are they doing this? Well, the answer seems pretty clear. This weirdness in the paper market is just a symptom of what's happening in the real world, a very real and growing shortage of actual physical silver. You see, to get this, you gotta understand the difference between the West and the East. The COMEX, that's the market in the West. It's mostly a paper game. It's financial speculation. But the Shanghai Futures Exchange in the East, that's a completely different animal. It is a physical market. If you want to play there, you've got to have the actual metal. There is no faking it. And you can see exactly what I mean right on this chart. Clear as day. Since mid-November, the price in Shanghai has just completely broken away from the West. It's trading at a huge and growing premium. Now, this isn't just speculation, folks. This is a powerful signal that real physical demand is pulling the price up, regardless of what the paper contracts say. And that right there is the golden rule of commodities. You can play all the games you want with paper for a while, but sooner or later, the simple reality of physical supply and demand always wins. Shanghai is screaming that the physical market is incredibly tight. And if you need more proof, here it is. Even major players like Bloomberg are reporting on this. China, which is a massive hub for global demand, is literally running low on silver. I mean, when their stockpiles are hitting a 10-year low, you better believe the entire global market is going to feel that squeeze. Okay, so now let's switch gears and look at the price charts, because the story that the physical market is telling us, it seems to be showing up in the price patterns themselves. It's fascinating. The first number that just jumps off the page is $75 an ounce. And look, this isn't some random number pulled out of a hat. It's a target that's coming from two totally separate technical patterns. The first is a classic bull flag, which often signals a big, sharp price move is on its way. The second is a long-term Fibonacci ratio, another tool traders use to project prices. The amazing thing is, they're both pointing to the exact same spot, $75. But it gets crazier. If we zoom way out, I mean way out, something absolutely monumental comes into view. We're talking about a massive chart pattern called a cup and handle that has been forming for, get this, 45 years. It started all the way back in 1980, and it looks like it is breaking out right now. A pattern that big signals a truly historic move could be on the table. So, what's the price target of a 45-year-long pattern? It's a number that sounds almost absurd, but the technical projection points to $670 an ounce. Now, who knows if it'll ever get there, but what the chart is telling us is that there is a release of pressure building up that could be of historic proportions. So, if the price even starts to move towards these targets, what happens to all the people who bet against silver? Well, this is where it gets ugly. This is where we get into the mechanics of a squeeze, and it turns into an absolute financial pressure cooker for them. Okay, the key concept you have to wrap your head around is called mark-to-market. All that means is that every single day the exchange settles up. If you bet against silver, if you're short, and the price went up, You don't just have a loss on paper. Nope. You have to find real cash and deposit it into your account that very day to cover your losses.
And it's just this relentless, painful cycle. The price goes up, the shorts get a margin call, they have to find more cash, day after day after day. Just a $1 move up in price can cost them billions collectively. A $10 move, it's catastrophic. It's this slow-motion financial bleed that just drains their capital, long before anyone even has to think about delivering physical metal.
And this puts them in a truly impossible spot. They basically have 4 terrible choices. 1, they can try to roll their bet to a later month, but that gets super expensive. 2, they can try to buy back their contracts to get out of the trade, but their own buying just pushes the price of silver even higher, making their problem worse. It's a vicious cycle. 3, they could try to deliver the physical metal, but there just isn't enough available. And finally, 4, they can do nothing and just pray, while bleeding cash every single day until they're completely wiped out. You see, they are totally and completely trapped.
In all of this pressure, the physical shortage, the rising price, the bleeding shorts, it's all coming to a head. It's all converging on one specific point in time, March of 2026. You just need to know 2 dates. February 27th is first notice day. That's when anyone who is short has to put up or shut up. They have to declare they actually have the physical silver to deliver. Then on March 26th, it is game over, last trading day. If you are still short at that point, you could be forced to go out and find millions of ounces of silver that you don't have and that you probably can't get. So that's the big question, isn't it? What happens if the shorts can't deliver? What happens if the whole system gets overwhelmed and the COMEX paper market simply can't make good on its promises with physical metal? Well, the exchange has one last emergency exit. It's called cash settlement. They can basically just declare the game over and pay everyone out in cash. But if they do that, the COMEX is essentially admitting to the entire world that it's not a real physical market anymore. All its credibility, gone. And at that moment, the real centers of physical demand, places like Shanghai and India, they become the new global price setters. And for the first time in maybe 50 years, the true market price of silver could finally be revealed. And that leaves us with this final, really powerful question. Are we about to witness a fundamental power shift in the entire global financial system, where the authority to set the price of real, tangible assets finally moves away from the paper markets of the West and over to the physical markets of the East? It's an absolutely fascinating scenario, and we'll all be watching to see how it unfolds.